Welcome, everyone, to this deep dive. Today, we're tackling something pretty crucial if you're an NRI thinking about selling property back in India.
That's right, the income tax side of things.
Exactly. It can feel, well, a bit like navigating a maze, can it? Cross-border sales, different tax rules.
Definitely, lots of moving parts.
But we're going to try and clear things up. We'll focus mainly on capital gains tax and, importantly, tax deducted at source TDS.
Yeah, those are the big ones. We'll break down what you really need to know.
Great. So if you're selling property as an NRI, where do we even start? What's the first hurdle?
Well, first off, you need to understand how India classifies the profit, the gain you make. Is it short-term or long-term? That distinction is fundamental.
Okay, short-term versus long-term. And I assume that depends on how long you've actually held the property.
Precisely. It all hinges on the holding period. The magic number is 24 months.
24 months, so 2 years.
Yep. If you sell the property having held it for 24 months or less, any profit is a short-term capital gain, STCG.
And if you've held it for longer than that,
Then it becomes a long-term capital gain, LTCG. More than 24 months puts you in long-term category.
got it. 2 years is the key. Less is short-term, more is long-term. So how does the tax treatment differ? Let's start with short-term gains, STCG.
Right. For STCG, it's relatively straightforward in a way. The gain is added to any other income you might have taxable in India for that year.
Ah, so it just gets lumped in with other income.
Essentially, yes.
Yeah.
And then it's taxed according to the normal income tax slab rates applicable to you for that financial year.
Which means you also pay the surcharge and cess on top of that, I guess.
Exactly. Surcharge and cess apply just like they would on your regular income.
Okay, makes sense. Bundled in, taxed at slab rates. Now, what about the long-term gains, the LTCG? I know things have gotten a bit more complex there recently.
Yes, they have. There's a key date involved, July 23, 2024. The rules differ depending on whether you sold before that date or on or after it.
Okay, let's break that down. What if the sale happened before July 23, 2024?
For those sales, LTCG was taxed at a flat rate of 20%, plus surcharge and cess, of course.
20%. And you also got indexation benefits, right?
Crucially, yes, you got the benefit of indexation.
And indexation, just to remind everyone, that's adjusting the purchase price for inflation, yeah. So you're taxed on the real gain.
Precisely. It accounts for the fact that money was worth more back when you bought the property, so it reduces your taxable gain.
Okay, so that was before July 23rd, 2024. What happens for sales on or after that date?
The tax rate changes. It drops to 12.5% plus surcharge and cess.
12.5%, that sounds lower.
It is lower, but, and this is the important part, you lose the indexation benefit. No indexation allowed for sales on or after July 23, 2024.
Ah, okay, so a lower rate, but potentially a higher taxable amount because you can't adjust the original cost for inflation.
Exactly. Especially for properties held for a very long time, losing indexation can significantly increase the taxable gain, even with the lower rate.
That's a really important trade-off to understand. Now, I remember hearing something about residents getting a choice between these methods. Does that apply to NRIs?
Good question. No, it doesn't. Resident individuals selling property they acquired before July 23, 2024 do get an option. They can choose either 20% with indexation or 12.5% without it.
But not for NRIs.
No. For NRIs, it's fixed based purely on the sale date. Before July 23rd, 20% with indexation. On or after July 23rd, 12.5% without indexation. No choice involved.
Okay, crystal clear. NRIs don't get that option. So we know the rates. How do you actually calculate the gain itself? What's the basic formula?
The basic formula is pretty standard. You take the sale price.
What you sold it for.
Right, and from that, you subtract the purchase cost, what you originally paid.
Okay.
You also subtract any costs of improvement you incurred over the years. So think major renovations, additions, that sort of thing.
Right, not just routine maintenance.
Correct. Capital improvements. And finally, you subtract any transfer expenses costs directly related to the sale, like brokerage, stamp duty paid originally,
Yeah.
legal fees for the sale.
Got it. So sale price minus purchase cost, improvement costs, and transfer costs. That gives you the gain.
That gives a capital gain, yes, which is then classified as short-term or long-term based on that 24-month holding period.
And that indexation we talked about, that only applies when calculating LTCG for sales before the July 2024 date, right?
Exactly. For those pre-July 23, 2024 LTCG calculations, you'd apply the cost inflation index to inflate the purchase cost and improvement cost before subtracting them.
But for sales on or after that date, you just use the original unadjusted costs.
Right. No indexation adjustment for those later sales. Simpler calculation maybe, but potentially higher tax, as we said.
Makes sense. Now, are there ways for NRIs to reduce this tax hit on long-term gains? Any exemptions available?
Yes, thankfully there are. The two main ones NRIs might use are Section 54 and Section 54 EC of the Income Tax Act.
Okay, Section 54, what does that cover?
Section 54 allows you to claim an exemption on long-term capital gains if you reinvest the gain amount into another residential property in India.
So, sell a house, buy or build another house in India.
Essentially, yes. There's a cap now, though. The cost of the new property cannot exceed INR 10 crore for the exemption to apply to the gains reinvested.
10 crore cap on the new property cost. And are there time limits for this reinvestment?
Yes, strict timelines.
Hmm.
If you're buying a new house, you need to do it either within 1 year before the sale of the old one or within 2 years after the sale.
1 year before or 2 years after?
And if you're constructing a new house, the construction must be completed within 3 years after the date you sold the original property.
Okay, stick within those windows, and you can potentially exempt the reinvested LTCG portion up to that 10 crore limit on the new house cost.
That's the idea. It's a way to defer the tax if you're rolling over your investment into another Indian home.
What about the other one, Section 54 EC?
Section 54 EC is a bit different. It applies to LTCG from selling any land or building, not just residential.
Okay.
And the reinvestment isn't in property, but in specific bonds issued by entities like the National Highways Authority of India, NHAI, or the Rural Electrification Corporation, REC.
Infrastructure bonds, essentially.
Right, and you have to invest within 6 months of the sale date. There's also a cap on the investment amount for this exemption. It's currently 50 lakhs per financial year.
50 lakhs into specified bonds within 6 months. So 2 different routes for potential LTCG relief. Reinvesting in house under Section 54 or into bonds under 54 EC.
Exactly. Useful options, but you need to meet the conditions precisely.
Definitely. Okay, let's shift gears to TDS tax deducted at source. This always seems to cause confusion. Who's responsible when an NRI sells property?
This is key. When an NRI is the seller, the responsibility to deduct TDS falls squarely on the buyer.
The buyer deducts the tax, even if the buyer is also an NRI.
Yes, it doesn't matter if the buyer is resident or non-resident. The buyer must deduct TDS before paying the seller. Think of it as a prepayment of the seller's tax.
Okay, and how much do they deduct? What are the rates?
The rate depends on whether the gain is long-term or short-term, and it's applied to the capital gain amount, not the wholesale price generally.
On the gain itself. So for LTCG.
For LTCG, the TDS rate mirrors the applicable tax rate. So 20% plus surcharge and cess for gains from sales before July 23, 2024.
And 12.5% plus surcharge and cess for sales on or after that date.
Correct. And for STCG, the short-term capital gains.
What's the TDS rate there?
It's higher. It's 30% plus applicable surcharge and cess deducted from the short-term gain.
Right, 30% for short-term. So the buyer calculates the gain, applies the relevant rate, 20, 12.5, or 30% plus extras, deducts that amount. Then what?
Then the buyer has to deposit that deducted amount with the Indian government using the seller's PAN number.
Okay, under the seller's PAN.
Yes. This ensures the seller gets credit for that tax when they file their Indian tax return. The buyer also needs a tax deduction account number, a TAN.
The buyer needs a TAN.
Yes, to deposit this TDS and file the required TDS return, which is Form 27Q. That needs to be filed within 30 days from the end of the quarter in which the tax was deducted.
Wow, okay, so quite a few obligations on the buyer there. What if the seller thinks the actual tax due will be much lower than the standard TDS rates? Can they avoid having so much withheld?
Yes, there's a mechanism for that. Either the buyer or the seller can apply to the assessing officer, the tax officer, for a certificate for lower or nil deduction of tax.
A lower withholding certificate?
Exactly. In practice, it's often the seller who is expected to get this certificate. If the officer is convinced the actual tax liability will be lower, they issue a certificate specifying the rate at which the buyer should deduct TDS, which could be lower than standard or even zero.
That sounds useful. Avoids tying up the seller's funds unnecessarily if the final tax bill is small.
It does. It helps with cash flow for the seller.
Okay, now let's flip it. What about when the buyer is an NRI? What are their TDS obligations? Does it work the same way?
When the buyer is an NRI, their TDS duties depend entirely on the seller's residential status.
Okay, so it matters who they are buying from.
Yeah.
Let's take the scenario where an NRI buys property from a resident Indian seller.
Right. If an NRI buys immovable property other than agricultural land from a resident seller and the value is 50 lakh or more,
50 lakhs, okay.
and Section 94IA applies. This requires the NRI buyer to deduct TDS at 1% of the total sale consideration or the stamp duty value, whichever is higher.
1%, not the 20 or 30% we discussed earlier.
No, just 1%. In this specific case, NRI buying from a resident, value over 50 lakhs. It's on the total value, not just the gain.
Okay, 1% on the total value. And when do they deduct and pay this?
Deduct at the time of payment or credit, whichever is earlier, and deposit it within 30 days from the end of the month of deduction using Form 26QB.
Form 26QB. And do they need a TAN for this one?
No. Interestingly, for Section 194IA transactions, the buyer doesn't need a TAN. They just use their PAN and the seller's PAN to file Form 26QB.
That's simpler.
It is. After depositing, the buyer must also give the resident seller a TDS certificate, Form 16B.
Okay. Is there a catch?
Well, a big one is if the resident seller doesn't provide their PAN. If the seller has no PAN or doesn't provide it, the TDS rate jumps from 1% all the way up to 20%.
Ouch. 20% instead of 1%. That's a huge difference. So
It's-
getting the seller's PAN is critical for the NRI buyer in this situation.
Absolutely critical.
Yeah.
And one other point. If there are multiple buyers, say a couple buying jointly, each buyer has to deduct and deposit TDS proportionate to their share and file their own Form 26QB.
Right. Each buyer handles their own slice. Okay, so that's NRI buying from a resident. What if the NRI is buying from another NRI?
That scenario usually falls under a different section, Section 195, which deals generally with payments and non-residents.
Section 195. Is it more complex?
It generally is, yes, because TDS under Section 195 is typically deducted on the income portion, meaning the capital gain of the non-resident seller. Calculating that accurately can be tricky for the buyer.
So the buyer needs to figure out the seller's capital gain to deduct the correct TDS.
Ideally, yes, which is why in NRI to NRI deals, it's very common and often advisable for the seller to obtain that lower or nil withholding certificate from the tax officer we talked about earlier.
Ah, so the seller gets the certificate telling the buyer exactly how much TDS, if any, to deduct.
Precisely. It simplifies things immensely for the NRI buyer and ensures the correct amount is withheld. Otherwise, the buyer might feel obliged to deduct at the higher rates on the gain just to be safe.
So for an NRI buyer, the absolute first step seems to be confirm the seller's residency status. Is that fair?
Absolutely. Nail that down first. Resident seller, probably Section 194IA, 1% TDS over 50 lakhs. Non-resident seller, likely Section 195, more complex, probably best if the seller gets a withholding certificate.
Getting it wrong could be problematic for the buyer, I imagine.
Very. Failure to deduct or deposit TDS correctly can lead to interest, penalties, and other issues for the buyer. So diligence is key.
Okay, that makes a lot of sense. So let's just quickly recap the main points for everyone.
Good idea.
If you're an NRI seller, the key is the 24-month holding period for short-term versus long-term gain. STCG taxed at slab rates. LTCG taxed at 20% with indexation before July 23, 2024, or 12.5% without indexation on or after that date. And remember, no choice for NRIs between those LTCG methods.
Don't forget the exemptions. Section 54 for reinvesting gains in another Indian house with a 10 CR cap on the new house cost, and Section 54 EC for investing up to 50 lakhs in specific bonds.
Right. And crucially, the buyer is responsible for deducting TDS on the capital gain, 20%, 12.5% for LTCG, 30% for STCG, plus surcharge and cess.
And if you're an NRI buyer, your TDS job depends on the seller. Buying from a resident over 50 lakhs, usually 1% PDS on the total value under Section 195 territory, TDS on the gain, much more complex best if the seller gets a lower nil withholding certificate.
So it really underscores the need for careful attention to detail, doesn't it? Whether selling or buying as an NRI, timelines, rates, who deducts what.
It really does. These aren't rules you want to get wrong. The implications can be quite significant.
Which leads to the final thought, I suppose. Given the complexities, especially with cross-border elements.
Yeah, it's almost always worth seeking professional advice. A good tax advisor who understands both Indian tax law and the nuances for NRIs can be invaluable.
They can help ensure you're compliant, you understand the implications, and you maybe take advantage of exemptions correctly.
Exactly. Navigating this landscape really does benefit from expert guidance.
Well, hopefully this deep dive has provided a solid map for navigating some of that territory. Thanks so much for clarifying these points.
My pleasure. It's complex, but hopefully a bit clearer now.